Let's bring in Malcolm Ethridge of CIC Wealth. He's also a CNBC contributor. Malcolm, good to see you. I guess the question would be, how much more would you expect the Fed might have to do to get that 2% inflation target within sight, and to what effect on the economy?
Hey, Mike. Yeah, so I think that the Fed Chair Powell has made it clear that he is absolutely committed to seeing this 2% target reached as far as the CPI number is concerned. And so I think it pretty much means that it's a when, not an if, as far as additional hikes are concerned later this year. I think they've already telegraphed 2 is the number that they already have on the table and are anticipating gets them to that target, even though they've also told us don't expect it to necessarily mean that we show up with a 2% CPI target, say in September, all of a sudden after the second rate hike in the same month. But they expect to let it play out from there because they think that's where the terminal rate should be. So I think we should at least set our sights on 2 hikes this year, probably in the third quarter of this year. And then we'll see how long it takes to get back down to 2% from there. But that 2 is pretty much baked in, I think.
You know, it's fascinating that we're at this moment where there's, on one side, plenty of folks who have great confidence that the gravitational pull on inflation is strong. And you can look at the leading indicators. It seems like we have a beeline in the coming months, at least toward 2%. And others are saying, look, the economy's running too hot here. You have stock market up. You have wage growth still strong. It's getting sticky around the 4% level. Where do you come down on that? I mean, do you actually think it's going to be a struggle from here or a relatively clear path to get inflation lower?
So I think what we end up seeing is that it does take a lot more work and more time to get that number down from something with a 4 handle down into the 2s. It's sort of like for anybody who's tried to lose significant weight, right? The first 20 pounds are probably the easiest, and that last 5 is what really persists and takes the most work to get rid of. But I do think also Powell has kind of shown his hand and said that it's going to take about 2 more hikes before they finally see the numbers that they want to see. I think it's really just a matter of how long will rates stay as high as they do at that terminal rate before they finally peel it back and say enough work has been done and we can kind of just wait and see from here. But I think also he's tipped his hand in saying that their plan was to tighten until something broke. And I think no matter which side you fall on, we can all sort of agree that not enough has meaningfully broken to this point that would signal that they're going to back off of the gas pedal and allow us to coast from here. So we should all be seeing that at least 2 more hikes are what's going to come. It's just a matter of how long do they hold on at that terminal rate at that point before they decide to start initiating cuts and easing off a little bit.
Powell does seem prepared to try to let time do some of the work at some point here. What does it mean for you in terms of the playbook? Is it just sort of, okay, now just position as if there's a slowdown coming and be defensive, or are there other things to do?
Yeah, I think it depends, obviously, on where you are as far as your investing time horizon is. But I also think that this market that we've had so far through this year, the first half of the year, has really been a gift to those who really need to take a gut check here and see if they should be positioned as aggressively as they currently are. I read a piece in the Journal this morning that actually was highlighting the fact that far more boomers are allocated 100% to stocks or something close to it than they probably should be at this point. And I think for anybody who's been looking for the exit ramp, not sure if you want to leave the party yet, I think the market being up significantly the way it has on this tech rally has really presented you with a second chance to get out of the market, not necessarily all the way, but at least get some of your portfolio tilted toward lesser risky assets, maybe CDs, for example. I've been seeing clients buying way more CDs the last 6 months at our firm than I have at any other point in my career. It doesn't hurt that, you know, the 12-month is paying something north of 5% right now. Mm-hmm. So if I'm talking about a risk-free rate of 5% plus versus I'm out 15% so far for the year, do I really want to keep on chancing it? I think that this is a really good time for anybody who knows deep down in their heart that they should not be allocated as aggressively as they have been to sort of start to take profits here and get out of the way.